Jobless claims just hit a several-month high, jumping by 18,000, according to the Labor Department today. That spike is being blamed on a spring break surge, according to Bloomberg. Continuing jobless claims also ticked up to 1.9 million, but experts say, calm down, don't panic. Layoffs are still historically low, and many companies remain in a wait-and-see mode amid ongoing tariff uncertainty. Dale Smothers of RDS Wealth Management joins me now. Dale, good to see you. Glad to have you back. So, this spring break spike, what's going on here? A seasonal blip or something bigger brewing?
Certainly a seasonal blip, at least in the numbers that we're seeing here. Alicia, you hit it right on the head there. It's a spring break seasonal thing that's taking place with any educators or maybe part-time support staff with schools as spring break comes around. Some of those educators or even part-time support staff may be eligible for some unemployment benefits, and they're applying for those during the week or week and a half of spring break. What is maybe a more underlying, spring break type seasonal blip is something we can dismiss. But when we think about the continuing claims, which is a measurement of those who have been on unemployment benefits and stayed on unemployment benefits, that measure is getting a little higher than what we would like to see. It's the highest since November of 2021, according to the Labor Department. And why that matters is we're really hoping, and the market has certainly priced in, for a rate cut. And if unemployment begins to be a little bit of a pressure, if you will, we could see that coming a little bit sooner. The market's already priced that in. It's good for us to see these numbers and analyze perhaps what the Fed may think in the future. But trying to make trades on this, Alicia, like you said, just calm down. Don't overreact to it, because making a trade in or out of the market based off of unemployment claims, kind of like driving your vehicle and looking in the rearview mirror when doing so.
I heard you say you're expecting a Fed rate cut. Is that what you said? Did I hear you right?
Yeah, so the market has certainly priced in some rate cuts in the coming meetings, and I expect that to happen as long as unemployment is not, as long as inflation does not go in the opposite direction. And I think, to be honest with you, a lot of that rate cut would have likely already been here had we not seen the uncertainties of what the tariff and trade wars could bring to prices in America. And again, that will be a little bit of tailwind in the overall market.
Yeah, speaking of all that, when you factor in the wave of new business investments in the U.S., the cooling inflation, the Ukraine minerals deal, potential tax cuts for those who need it, that big, beautiful bill President Trump has been talking about, are we headed for trouble due to a slight GDP slip and that tariff uncertainty you were talking about? Or is there a bigger picture here? What's your expert read on where the economy stands and maybe more importantly, where it's headed?
Sure. The economy has had a lot of uncertainties thrown its way, and a lot of American companies are in a wait-and-see mode, just like you alluded to as we were opening here. But I do forecast a rebound in the markets and in American businesses, simply for the fact that we have deregulation that has still not been initiated by the Trump administration. We have a tax cut that is likely to be made permanent, just as you were alluding to. And not only the tax cut made permanent, but additional tax reductions or eliminations on things like overtime, tips, and here's the big one, Social Security taxation. That will likely generate a lot of extra income into middle American families. When we see China come to the table, Alicia, I think that investors will be benefited, greatly benefited, for staying the course in American names such as Amazon and Apple and Microsoft, NVIDIA, these companies that have let us down in the market, significantly down, tech-heavy names will likely see a pretty steep rebound from where they're at today. So the last thing we want to do is sell in these lows, and I do see brighter days ahead. The timing, clearly, that's anyone's guess. I think the market bounces around just a little bit here for the next 2 to 3 months. But when China sits down and is ready to make a deal, look out.
All right, sounds like you're hopeful that China will make a deal. I am too. I mean, it would be in their best interest. So what you're saying is there are offsets in the economy too, and you have to look at the bigger picture, not just that myopic view of a few statistics. But now, all eyes are turning to the job report Friday. Are you expecting a hiring slowdown or what?
Naturally, I would expect a hiring slowdown. Now, the experts guess at these things and then they're surprised. And what's also funny is that once the news comes out, a couple of weeks goes by and revisions are made on the readings and reports. I think if I were a Fortune 500 company wondering whether or not I needed to onshore every bit of my operation here, I would be pushing the pause button on hiring. And again, I don't think that that's something that we should be concerned about in the long run. However, if this continues, if we do see a continued job hiring slowdown and it lags into potential for recession, that could become a self-fulfilling prophecy if we're not careful. That's not in our cards. When we're advising clients of our firm, RD Smothers Wealth Management, we are certainly not saying to them that we expect a recession. We like to invest right here in a way that allows us to embrace this optimism that is likely to make the market have a V-shaped recovery, but still have things in a protective mode if the market does tumble, if we've got people that are looking for income. So depending on where you are, Alicia, to kind of indirectly answer your question here, depending on where you are, a lot of what we're going to see over the next 2 to 3 months is likely just noise. And again, depending on where you are in your journey, you can turn them off or maybe put your noise canceling headphones on and just stay the course. If you're a long-term investor, use this as a buying opportunity. If you are a retiree who's close to or in retirement, you need to be looking at your portfolio very strategically, not selling indiscriminately, and you need to be positioning yourself for potential 2 to 3 months worth of turbulence here, but still not so scared that you can't rebound with the market when it takes place.
Okay, good advice as always, Dale Smothers, RDS Wealth Management. Appreciate your time today.
Thank you, Alicia. Good to be with you.